Hello and welcome to a CMS Forex Daily Video Recap. I'm your Fundamental Market Analyst, Nick Nassar. Today is Wednesday, June 16, 2010. Let's start today's broadcast with a look at the Euro-Dollar pair, as the Euro came under pressure, especially overnight, as we had some fresh worries about Eurozone sovereign debt and rumors about Spain needing to request aid from the EU or IMF, which dented risk appetite. Despite the news, the Euro rebounded from its overnight lows around 1.2250, as we had some positive US data, and that helped to boost risk appetite, though we did not manage to reach the highs we had set overnight or in yesterday's session. Now, we had a news article report that the IMF, the EU, and the US Treasury were preparing a 250 billion euro liquidity facility for Spain. The report was denied by Spain's government, and an EU official said the rumor was rubbish. Still, the gap in yields between 10-year Spanish bonds and German government bonds hit the widest level since the euro was introduced, as the gap increased to 2.235 percentage points, as the 10-year Spanish bond yielded 4.881%. The widening spread between German and Spanish bonds is a sign that investors are increasing the risk premium to buy Spanish bonds. The worries come as the Spanish government plans to auction off 3.5 billion euros in long-term debt tomorrow. Despite the concerns about Spain, the euro did prove resilient in today's trading, as we rallied following the better-than-expected industrial production data from the US. We have been in a rally in this pair for the last week and a half, and we could draw this upward sloping channel. Coming into today's trading, we have been testing the resistance of that channel, and in today's trading, we moved back to for the last week and a half, this pair has been rallying in favor of the euro, and we find ourselves in this upward sloping channel. Heading into today's session, we had tested the resistance of that channel, and our low came close to testing the bottom of the channel, which was also close to our 50-period moving average, from which we bounced up off of. Today's low was also a 50% retracement of our most latest upswing from low to high in yesterday's session, and we could see we tested the 50% rather perfectly. So while we remain within this upward channel, the fact that we weren't able to move above our recent highs could be a worrisome sign for this rally, but we would need to move below this support trend line before it would be an actual bearish signal. Turning to some fundamental data, in the UK, the number of people claiming jobless benefits dropped by almost 31,000 in May, exceeding the median forecast. The ILO unemployment rate declined to 7.9% for the 3 months through April. This is a good sign for the recovery in the UK, but we must remember there will be a large round of government spending cuts coming down the line, which may hamper the recovery after 2 quarters of growth. Still, in the charts to the right, we can see the drop-off in claims the past 5 months or so. However, in a negative report, concerns about the budget cuts to be announced on June 22nd and the chance that it could slow the pace of economic growth did restrain consumer confidence during the month of May. The nationwide building society said today that its household sentiment fell last month by the most since July 2008, a 10-point drop in the index to 65, almost erasing the gains made over the previous 10 months. A gauge measuring expectations for the recovery in the next 6 months fell by 12 points to 93. The pound was higher for most of today's session, first boosted in the European session by its employment data, and then in New York trading as we had the positive industrial production data that we'll take a look at in a second. However, in late New York trading, we saw the pound give up its gains and fall rather sharply following comments from Bank of England Governor BOE King. Now, before we get to those comments, taking a look at this pair in more context, we also see this upward sloping channel, similar to what we have in the euro-dollar. This goes back for a much longer time frame, and we could see that we were rubbing up against the resistance of that channel at today's high at around 1.4850. So we did have a technical situation setting up if we had some negative data in terms of the pound. We got that data from a Bank of England governor's speech at the Mansion House in London, in which he said that the Monetary Policy Committee of the Bank of England won't hesitate to withdraw monetary stimulus when necessary, but that the UK economy has none of the traits associated with continuously rising prices, and policy must be set in light of fiscal tightening and financial market fragility. He said a continuous rise in prices would ordinarily be associated with strong money growth, wage inflation, rapid increases in money spending, and an excess of demand over the supply capacity of the economy, and that so far the UK economy exhibits none of these traits. So the bottom line here was that there will be no hike in UK rates anytime soon. That pressured the pound as it slid below 1.4750, our low for today earlier in the session, and came down to 1.4728, the 100-period simple moving average in a 1-hourly chart. That was also a 38.2% retracement of our full move from Friday's low near 1.45 to today's high at 1.4850. I had mentioned earlier some positive U.S. data, and it came in the form of U.S. industrial production for the month of May, which marked its third straight consecutive gain as it rose 1.2% higher than forecast of about a 0.9 to 1% increase. Widespread growth across most major industries helped boost manufacturing output by 0.9%. This is good news for the real economy in the U.S. as it shows that the manufacturing sector continues to power the U.S. recovery and extends its V-shaped recovery that we could see here in this chart to the right. Also, the U.S. capacity utilization rate rose to 74.7 in May, a percentage point gain from the previous month, extending the string of gains we have seen in capacity utilization rate starting with the middle of last year. However, a second measure of the real economy, a look at new home construction starts, came in far below expectations, showing the difficulty that the housing sector is having. Starts fell by 10% on the month to an annual pace of 593,000 when the consensus was for a 5.2% decrease. Building permits, a measure of future constructions, also fell more than expected to an annual pace of 574,000. Single-family housing starts dropped 17.2% to the lowest level in a year at an annual pace of 468,000, though apartment constructions or housing with 2 or more units surged by 33%. Overall, builders remain cautious about sales prospects absent the government's support programs as we came to the expiration of the homebuyer tax credit. As one person put it, the report reminded him of what happens when an athlete stops taking steroids. While prices and mortgage rates are low, job market improvement is weak, and also builders are having trouble getting financing. Also, many of those buying homes have opted for the used market, as existing homes are cheaper than the newly built, even more so with the wave of foreclosures that drove down prices. Therefore, it just doesn't seem that there is need to create a bunch of new homes within the U.S. However, that'll affect the construction sector, especially jobs, as well as cut into economic activity in the second half of the year. Finally, today we had a look at inflation pressures in the U.S. as producer prices fell on the back of lower energy and food prices, although the cost of certain finished goods did continue to move up. The producer price index fell by 0.3%, which was a better reading than the consensus, which had it falling 0.5%. Producer prices, excluding food and energy, or their so-called core rate, rose 0.2% higher than the forecast and matching the reading we had in April. Energy prices were down 1.5%, where food prices dropped by 0.6% last month. For the 12 months ended May, the producer price index rose by 5.3%, slowing down from an annual increase of 5.5% registered in April. The core PPI index rose 1.3% year over year. Tame inflation gives the Federal Reserve additional comfort to keep interest rates close to zero for some time to help bring unemployment down. Europe's debt crisis and a disappointing U.S. jobs report for May should also help reinforce the mainstream view at the central bank that rates must remain at a record low, perhaps into next year. The Fed's policy setting body next meets on June 22nd, 23rd, which is the middle of next week. Taking a look at one of our commodity currency pairs, the US dollar Canadian dollar, we see following a move in favor of the greenback in overnight trading as we tested the 1.03 level. In New York trading, we saw the pair move in favor of the Canadian dollar on the back of some risk appetite following the better than expected industrial production data. However, we were unable to move below our low on Monday at around 1.0225. Bank of Canada Governor Mark Carney said the country needs a subtle approach on interest rates to balance the competing needs of strong domestic growth with ongoing problems in other global economies. Carney's comments are the latest indicator that the central bank may not continue to hike interest rates in coming months after raising borrowing costs for the first time in 3 years in June. Quote, in light of the scale and volatility of these conflicting forces, it should be evident that no particular path for monetary policy is preordained. Canada's economy is forecast to be the fastest growing in the G8 this year, with first quarter GDP growth topping 6%. Still, policymakers are warning that problems affecting other world economies, such as the debt crisis in Europe, have the potential to crimp growth in Canada. Taking a look at the Australian dollar US dollar, we were unable to move above our resistance here at the 0.8660 level as we consolidated in a tighter range than we have seen in recent trade. So like in the euro dollar pair, our risk rally, which we had seen start at the beginning of last week, is taking a pause or a breather, and we'll see if we're able to move above this resistance level in the coming sessions. If not, we might see another move back down to the 0.85 level in this pair. And that's all the time I have for today. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.